Good afternoon, everyone. So thanks for attending this session. So our topic today is riding the reopening wave with the S-REITs leaders. Actually, we have made this call since late last year. So now it's a good time to check whether how it goes and the potential impact of the Fed fund rates continuing hike. So if you look at this page, actually, we still believe investors should turn to S-REITs for growth. This is because the Singapore's reopening. It's the key to returning to growth. But comparatively, the US and Europe economies are still fighting with the potential growth slowdown, but with the elevated inflation. So my presentation will divide into three parts. The first one will be why S-REITs, and followed by the market outlook, and why investors should consider a diversification in S-REIT leaders' names under a ETF vehicle. So first of all, why S-REITs? I think most of you are quite familiar with this concept. We still think the S-REITs is very attractive due to its dividend yield as well as its inflation hedge features. This is particularly true if let's say the Singapore inflation is going to peak soon. If we jump to this page, as shown on the left-hand side, you can see here the S-REITs, its dividend yield is actually higher. It's nearly 6% now. It's higher than the Singapore core inflation rate and also higher than the STI dividend yield, as well as the SGD deposit rate, as well as the Singapore 10-year bond yield. And more importantly, if you look at the chart on the right-hand side, it not only has a higher yield versus the Singapore major asset classes, but also has a higher yield than their REITs peers, for example, in the REITs in the Asia-Pac region, and also the Asia-Pac equities. And it also has a relatively lower volatility if you look at the left-hand the bottom, the horizontal axis, which means if we combine this relatively high yield versus a relatively low volatility, this is actually translates into a high return risk ratio. And if we consider the potential inflation change in the next couple of years, I think the relatively high yield of the S-REITs is more valuable because in the next couple of years, the Singapore inflation is expected to slow, but the S-REITs yield is expected to remain stable or even slightly higher. So it definitely can act as a very good hedge versus the inflation for now. And this stable dividend yield also contributes to the S-REITs outperformance in the history. And if you look at the top line, actually over the past nearly 7 years, the S-REIT leaders, they have average annualized return of 6.4% in SGD. And if you look at the chart here, even we compare this S-REIT performance versus their major global US and APAC REITs peers as measured by US dollar performance, it also has had the best performance in the history. And even during the market stress times, for example, since starting from the November 2021, which is also the time when we launched our S-REIT ETF, we can see the S-REIT actually outperform the US stocks, both the value stocks and growth stocks, including the S&P or the Nasdaq. And it's also outperformed the US nominal bonds, the US Treasury bonds, as well as the US inflation-linked bonds, and even the Hong Kong's Hang Seng Index in terms of the US dollar performance. I think the reason behind is quite straightforward, because S-REIT is always treated as an asset class between the bond and equities. So as compared to the bonds, it does has a growth component because it has a rental income from time to time. But as compared to an equity, it also provides a less volatility because typically it has a longer WALE, which is the weighted average length expiry. That's why it looks more aggressive versus the bonds, but more defensive versus the equities. That's why they can balance these two, the risk and return, and achieve a outperformance over time, even market has experienced a downturn. And in the second part, we'll start from a macro outlook because investors now are still concerning, say, about the elevated inflation, the monetary tightening, and the recession risk. So we'll discuss all of this in details and see whether these factors are actually applicable to the to S-REITs. And starting from these slides, I think at least one of the good news for now is that the inflation is peaking in most of the major developed markets. I think obviously it's a positive sign. And also the Singapore inflation also follow a very similar trend, also start to peak. I think the potential peak of the inflation, they have two implications here. It not only means the S-REITs may have a potential lower operational cost, let's say in the next couple of quarters, but also means the interest rate is also may need to go, is going to peak. And if you look at this slide, I show on the left-hand side, the time series, both the long-term and short-term U.S. Treasury yields, they already show some signs of the peaking of the interest rate. And this also echoed by the U.S. Treasury yield curve. It's quite flat or even inverted, which means we perhaps already after the most recent fund rate hike, let's say on the May 4th, we perhaps is already, these most aggressive rate hikes is coming to an end. And another positive sign is that the Singapore rates is already peaking even below the US interest rates. I think here the implication is that as compared to the US rates, the S rates obviously has less pressure because their interest cost is lower than US rates, but the yield is still relatively higher than the US rates. And let's suppose the Fed finally already decide to take a pause. And historically, S-REITs actually benefit a lot from this potential peak of the interest rate, because based on the historical experience, the S-REITs, the absolute return for the S-REITs is nearly 20% during the period 6 months to 12 months after the Fed take a pause. And additionally, if some investors decide to move in advance, let's say a couple of weeks or a couple of months or up to 2 months ahead of the Fed pause. Actually, investor, at least in the history, they may had another 200 bips or 2% outperformance in addition to this 20% total return. So from this perspective, we are quite constructive on S-REIT performance on the back of a potential peak of the REITs or even the lower interest rate, let's say later this year or early next year. And the investor may have another concern about the growth, because this year, obviously, the growth across the globe may be slower than last year. But if we specifically talk about the Asia or Singapore growth, which the S-REITs has the largest or dominant exposure, actually they still quite resilient, because the Asia growth is expected to be around 5%, and Singapore growth expected to be 2%. So from this perspective, their growth still remain relatively insulated. So from this perspective, the S-REIT may still get some fundamental support. And valuation-wise, I have to say the yield spread, as shown on the left-hand side, the 300 bips spread is not that attractive, but also fair enough as compared to history level, because now the risk-free rate is still at a relatively high level. But PB, the price-to-book level, are still below 1. I think it still shows some attractiveness in terms of the inflation. And more importantly, with the inflation at current levels, we still believe the gross yield is still the better metric. For example, if we talk about a 5% core inflation, at least the S-REIT has a nearly 6% dividend yield, so still can outperform their inflation. But comparatively with the US REITs, which offer a, let's say, about 4% yield, obviously they cannot beat their US inflation. That's why we think the S-REITs are still attractive from this angle. And fundamental-wise, again, the employment in Singapore is still quite strong. It's even lower than the pre-COVID level. So even we are talking about the GDP just expand 0.1%, but from a job market perspective, the fundamental support are still there, and it's also worth to note that the Singapore households are still very healthy. The average net assets, it's quite impressive at 2.25 million per capita. I think obviously tracked up by some rich people, but the average number is still impressive, and the average the asset or liability to asset ratio is also quite low. It's just 13%. So if we read from here, I think from this perspective, we still can expect some improvement in terms of the consumption. And again, we already seen the first round of the rebound in terms of the tourists, maybe since late last year or early this year. I think now we should rely more on the China's tourists. If they can return to Singapore, then we can see more boost to the Singapore REITs, in particular for the retail REITs and also the hospitality REITs. And the population growth in Singapore, although at a small absolute level, but still contributed to the Singapore long-term growth more from a structural perspective. And in this section, we will talk more about the sector outlook. We still believe the reopening theme are in place, but investors should balance between the defensive and cyclical names. And the first one is the industry REITs. If you look back the last year number, the warehouses and factory rents grew relatively steadily. But we have to admit that some leading indicators are already weakening. For example, the Nordics already weakening. So which means the growth may be slower or confirmed to be slower than last year. But good news for the industrial REITs that the long-term investment demand committed will support the demand for the industrial REITs. As shown here is that, for example, the positive change in the manufacturing and also the construction employment and also the committed FAI will also support the industrial REITs. And again, even we talk about this potential slower growth, as industrial REITs, they provide some defensive features. For example, 8 out of the top 10 pharmaceutical companies have facilities in Singapore. So despite the slower growth, the industrial REITs should remain stay resilient this year for the Singapore, particularly for the Singapore REITs. And again, the supply dynamics also quite okay because they largely pre-committed, so supporting the future rental growth. And moving to office REITs, I have to say Grade A rental growth may slow this year as demand normalized from last year levels. But the good news that the potential vacancies left by the tech firms may be refilled by the other types of firms. For example, the non-bank financial sectors and also some legal and tax advisory and insurance houses, as well as the fast-moving consumer good companies. So the supply and demand should still be quite balanced, and occupancy, as shown on the right-hand side, is still high at nearly 95%. And the below 10-year average office supply may also support the CBD office rents this year. And retail REITs is quite straightforward because consumption is anticipated to remain supportive. And if we combine this with a limited new upcoming supply, this will also support it to the rents for the retail REITs. And the improving visitor arrivals, as I mentioned before, so will also support the retail REITs performance. And someone may be worried about the online sales, but I don't think it's a problem in Singapore because the shopping malls here is not only a shopping place, but also a place for dining, entertainment, or kids' playground, or even the aircon. So obviously, it's not an issue for Singapore REITs. And hotel REITs, again, if it's we see more tourists from China or from elsewhere in the world, and it's also if we also take consideration of the potential limited new supply, new hotels, then obviously the RevPAR growth will be still getting some support. And in the interest of time, I will move into the last section because we will tell you why an investor should also consider a diversified portfolio in the SGX issued IHS Leaders Index. I will not go through every single detail, but I want to highlight three key features. First one, these leader index, their minimum market value threshold and minimum liquidity threshold can ensure the index only includes the large and mid-cap names. And secondly, their liquidity-based weightings can always help the portfolio capture the hottest investment market themes. For example, after the March rebalancing this year, we increased the weighting to the more defensive industrial logistic REITs, but followed by the office and retail REITs. And thirdly, if you look at the pie chart on the bottom right-hand chart, you can see even investors invest in S-REITs only. Their geopolitical exposures will be in APAC or even globally. So from this perspective, investors may still enjoy a tax benefit, but with exposure to the international REITs. And large and mid-cap S-REITs obviously has a scale advantage because they can acquire good quality properties, and with creating a bigger market cap and more stock liquidity. This will translate to higher stock valuations and help them to raise equity and acquire more projects. And that's why the large and mid-cap S-REITs outperform their smaller peers in the history. And also, it's worth to note that most of the large and mid-cap S-REITs, their sponsor have a government linkage, for example, the Temasek. So different from a lot of US REITs, they have a very strong funding channel and more stable funding channel. And that's why they are little impacted by the most recent, let's say, US or even the Europe banking crisis. And investors may ask if S-REITs is so attractive, why don't we buy the S-REITs directly instead of buying an ETF? I think this tell you one of the key reasons, because buying the ETF, they may potentially save the cost because much lower beta spread versus directly buying the underlying S-REITs. And also the ETF manager can also leverage our scale and network to lower the cost for investors and transfer these savings directly to the end investors. And this one will jump to this one, and this diversification advantage is quite obvious. It's reflected in the lower volatility versus directly holding the underlying names, and potential lower drawdown versus holding the single names. That's why we need a ETF vehicles. And here, as compared to directly holding the property and the individual S-REIT, we still believe holding S-REIT ETF, they have a much lower entry threshold, slightly below the $1, but also has a potential lower trading cost, lower beta spread, but with a higher diversification arrangement, but also with a high transparency. And now it provides a relatively stable yield, nearly 6%, which is 5.8%, but investors still are tax exempt, particularly for the dividend income for the individual investors. And this is a snapshot of our S-REIT Leaders Index ETF. We have AUM at SGD 90 million, and we have two counters listed on SGX. One is SRT in SGD, and the other one is SRU in US dollar. So investors can easily trade them on SGX with only starting from 1 unit only, or slightly below $1. And if investor wants to create shares, let's say 50,000 units, it's also okay. It's just like a creative mutual fund shares. And the distribution policy is semi-annually. Our policies here is that we will pay out all of our underlying dividend received. But if this dividend yield is lower than, let's say, the benchmark yield, we may also adjust up this dividend yield to be in line with the index yield. So the investors will guarantee the investors to get the yield they expect. And now the management fee is capped at 60 bips, which means that regardless of the ETF size, the ETF, the management, the fee will be capped at this level. And now the performance year to date, quite strong. The absolute performance is more than 5% and also outperform the benchmark by more than 30 bips even after the TER. And since inception, we outperformed the benchmark by 5 bips after the 60 bips fees, which means if you're adding back these the TER, we actually outperform the benchmark by 65 bips. So that's why investors can compensate by the lower trading cost, and also their TER fees will be offset by these outperformance, at least based on the current track record. And in summary, I think as compared to the holding a single S-REITs or single directly holding the property, we believe the holding an S-REIT ETF will provide investor more stable dividend return and also more diversification. But investors can also enjoy a potential lower tax or the tax benefit and also the lower liquidity trading cost. So this concludes my presentation. Thanks.